Hello viewers, welcome back to our cpacertification accounting tutorials, and today we are going to look at the golden rule of accounting, and we are going to basically look at what it means. And we know the golden rule of accounting is also known as the double entry. So the golden rule of accounting, the golden rule. We want to look at the golden rule of accounting. So the golden rule of accounting is also called the double entry rule. That's what we call the golden rule of accounting. And allow me to take off my video so that you can be able to concentrate on the work that we are going to go through for now. So the golden rule of accounting, or what we call the double entry. Now, this is the rule that directs us on the entries that we are going to make. It's the rule that is going to guide us on the different entries that we are going to be making as far as our transactions are concerned. So the golden rule, it is basically the rule that guides the use of recording. So the golden rule, it's basically the rule that is going to guide us. It's going to guide us in our recording of entries. In our recording of entries in accounts or in the books of accounts, especially the ledgers. That's where we are going to put more emphasis to be able to demonstrate the golden rule of accounting. And this rule was developed by an Italian person. We looked at him in the history of accounting, and he was the one who developed this rule. It's called FRA. It's by names of FRA. It's called FRA Luca Pacioli. So this is the person who developed this system in 1491. That's when he developed this, as we saw in our history of accounting, because we looked at how accounting came into existence, and we spoke about this person because he's the one who wrote the arithmetic, the book that was all about arithmetics, geometry, and other proportion stuff. So is the man who introduced this same rule. Now, but according to this rule, it says that for every transaction that you do in a business has two issues. It has a debit side and a credit side point of view. In other words, this rule looks at the sense that every transaction or every business transaction has to pass through what we call the same double entry. But in the sense that we spoke about what a transaction is, and we said a transaction is something, it's It is something that we are going to do, but it's supposed to be financial in nature. Now, what is going to happen with a transaction is that you are going to exchange money, and the other person is going to give you what you are buying. So there are always two things. There is a receiving end and a giving end. If you go to the shop to buy something, you give your money, they give you the goods. So you give out the money, they give you the stock. So there is always two-way. A transaction is like, it's an exchange transaction, but it's supposed to be having something to do with the monetary terms. So that's why they are saying that every transaction or every business financial transaction has to pass through the golden rule of accounting. So once a transaction goes through that, then we can say that we can see the effects to both parties. And for this person said, Pastorioli said that every transaction affects each of the parties to the transaction. It has a double effect. In other words, there is a double effect between the parties at each transaction, all the parties to the transaction. If there is a transaction that you are involving in and that transaction has monetary value or can be quantified in monetary terms, it has a double effect on each side of the parties to that transaction, and that's what we call the double rule. Now, the double rule, it has a double impact or a double effect. The impact for each party that is involved to a given transaction must record the transaction twice in their books. For example, if let's say I'm a seller of books and maybe I sell to you a book. I have a book, let's say I sell it, let's say $10. Now, if I sell to you this book, for you, you are going to give me cash or whichever mode of payment, but you are going to pay. You are going to pay almost the same amount. You are going to pay exactly how much I'm selling the book. So each side, you are going to be the buyer, then me, I'm the seller. Now, what they are saying for the double effect on each party, they are saying that on every transaction, the transaction we're dealing in is a sale of a book. When I'm selling my book, maybe for $10, what is going to happen is that each of us is supposed to record that information twice in their respective books. If I'm the seller of the book and I sell a book out, let's say the price is $10. The first effect that I will be having as a seller, it will be in a sense that I've lost the book. That is the first effect. I've lost the book. And the second is that I have gained the cash. It's like we've done an exchange, but this exchange is in monetary terms. We've exchanged, I gave you the book, you gave me the money. So there are two effects in each and every transaction. Now, what is going to happen on the side of the buyer? Because me, I'm a seller, as a seller, I've lost the book, but at the same time, I've gained the money through selling that book. In other words, instead of me having the book, I have $10. That is the implication. So those are two transactions on the side of the seller. Now, we want to look at what What are going to be those two transactions or the double effect from this same transaction? I've sold the book to the buyer. In the books of the buyer, what is going to happen? Now, on the side of the buyer, we are also going to have a double impact or effect, whereby this buyer is going to be gaining the book, is getting the book or gaining the book, is getting the book, but at the same time losing cash. In other words, his or her bank account has reduced, but he has gained a book. So you are going to see that you are gaining the book, but at the same time you are losing money by the fact that you are buying the book. Therefore, every transaction has a double effect on either side, on the either side of the parties that are involved to that transaction, whereby each party must do the double entry in their respective books of accounts. And that's what we mean by the double entry rule. Now, the double entry rule states that, unless we can have, maybe we can have the rule itself. So it states that every debit entry must have a corresponding, every debit entry must have a corresponding credit entry. Every debit entry must have a corresponding credit entry. In other words, if I've debited a given account, I must credit the other account. And also, because even the vice versa is true, but I'm not just going to say and vice versa is true, but and also every credit entry must have a corresponding debit entry. So that's the double, the rule in full, the golden rule of accounting. They call it the golden because it's the one that is guiding the entire accounting. Without understanding double entry, it's like you are just wasting time. Golden rule of accounting. So if you don't understand the golden rule or the double entry system of recording transactions, then you can't manage to do the accounting. So for every debit entry, we must have a corresponding credit entry. And also, for every credit entry, you must have a corresponding debit entry. So just like the way I've told you in the example of where you are selling a book to a customer, both of you are supposed to record transactions twice, or to record an effect twice of that sale of a book. So that's the golden rule of accounting, where for every debit entry must have a corresponding credit entry, and every credit entry must have a corresponding debit entry. That's it as per the rule. So it means that for every transaction that happens is we are supposed to record that same transaction twice. So using that same just example that I gave of a book, where if it is lost, then I must record to show that I have lost it. At the same time, I will record to show that I have gained the money. Therefore, the double entry rule simply means that for every transaction that occurs, then I have to do a double recording, where we are going to have one in a separate account to reflect the first effect, and the other in another separate account to reflect the second effect. Now, looking at what I have just said, I also want to add that double entry recording is done in accounts, because for what they are saying, that for every debit entry must have a corresponding credit entry, and these entries must be done in accounts. But we can't just proceed if at all we don't know what accounts are or what accounts is all about. So we need to first understand the concept of accounts before we proceed to do the double entry rule. So let's look at what is an account. If at all we understand that, then we can be able to proceed to the next level. I know we must have encountered an account somewhere, and we must have explained it in the previous videos, but we are going into we are going to give it a detailed background of what an account is all about. So I want us to know what is an account. It's really important to know what an account is. Now, we need to understand what an account is all about. And this takes us to another subtopic under the golden rule. But remember that I told you that a ledger, we looked at ledger in the previous video. So a ledger, as I told you, we said a ledger is the main principal book, is a principal book of accounts, book of accounts. Now, it's in this ledger, or it's in this book, in which we do what we call the double entry. We always do the double entry within this ledger account. We looked at the different ledgers that we have. So we do the double entry recording. And we said when you're recording in these ledgers, we call it posting. And not forgetting that I told you that a page of every ledger is divided into 2 columns, and each page is the same as the other. We can have maybe this as our page, the whole of this. Now we can say that it has columns that are equal. May not have a straight line, but at least we know. So this is a column, and also this is a column. So what we are meaning is that this, if this is 20%, even this one is 20%. Meaning they are equal, they are in proportion. If this is 100%, even the other side is 100%. Now, you see, once you look at this as your page, your page within a book, you understand that we have divided it into two equal sides. And now we are putting a bar at the top. Let me use it. This bar at the top, we are putting it there just to show, to illustrate how an accounting is all about. Now, once you have divided it and you have put a bar on top, that becomes a ledger. Because a ledger is going to be for a given, a ledger is just the whole book where accounts are. We said that a page of any ledger is what we call an account. An account is a page in the ledger book. But a ledger looks like a T account. It looks like a T, capital T. So it is in the form of a T. And that's what we are trying to make here. That's why we are putting a bar on the top to form our letter T, capital T. So every page of the ledger is going to be an account, meaning every page that we are going to be seeing, we are going to be having this. It's going to be looking like this, with a bar at the top, then with these sides being divided equally. Now, accounts, we've said, is basically a page of a ledger. And you'll see that every account is in a T form. It has the left-hand side. The left-hand side, this side, is the one that we call the debit side. And then the right-hand side is what we call the credit side. Now, on the top here, we always put the title of the ledger. If it is a sales ledger, we just say we just come and put sales up here, meaning it's going to be a sales account. So whichever it may be. So we said we put something here. If it is a sales, we put sales account. But we've said that the left-hand side is the debit side and the right-hand side is a credit, is also called the credit side. And what we mean is that, what we mean by the fact that for double entry, they are saying that for every debit entry, whichever you've made here, should have a corresponding entry. But that if it is a debit, then it's supposed to have a corresponding credit entry, but it can't be in the same account. So it means we shall be having two accounts, whereby this one is going to be debited. Let's say we've debited that, then the other account is going to be credited. And what is going to happen is that we are taking the information. If this is a sales account, we've, let's say, said maybe cash or bank, then what we are going to do, maybe we have received, we have, let me use something that has a debit entry, because this one, the sales doesn't have a debit entry. Let me just use an expense, rent. We've paid rent, and maybe we paid by bank on a given date. So what you are going to do, if this is your rent account, then we are supposed to say if we have paid cash, then the corresponding entry is the one that is going to be here. So we shall come to the cash account, and since the money that we have is reducing, we are going to put here, it is reducing in the names of rent. So you are seeing this account here is reflecting here. That's what we mean for every debit entry. And we are also seeing that this account here is actually showing here. The implication is that when you're debiting this account, the corresponding entry shouldn't be debited, it should be credited, but to the other account. You can't say that this is rent, then you just come and you put the figures here. It will be wrong, because we are supposed to have a debit this side and also credit on the other account. Then the reverse is also true by saying for every credit entry. Now, if let's say we have sales here, sales, so we can say maybe we have sold by cash. We've made a cash sale. We are going to credit this account in the name of cash. We put the amount there. Then we come to, because it is a credit entry, it must have a corresponding debit entry. So we shall bring that value here. But it's supposed to be in the name of sales, so that this account aligns with this, and also this one aligns with that. So that's the double effect that we are trying to talk about. So that's what I'm trying to pick out. So let's try to understand what an account, before we first illustrate the account, what the account is all about, before we go into start doing the numbers or doing computations. Now, we've said that for every debit entry, you must have a corresponding entry. In other words, whatever a debit side, like whenever you record on a debit side, you must find another account where you are going to credit. So if you have a debit side and you are recording on the debit side, then in a given account, maybe the sales account, whichever account it may be, you should go to another account and do the credit side recording. So we said at the top of the bar, that's where we have the name of the account. So if we say that we record cash on the debit side, then you also put the figure for cash on the debit side, or on the left hand side of the cash account. If we just go by the other topic, the other example which I gave, the one for selling a book to a given person, let me just give you something small. Let's say I've sold a book of $10, $100 to James. Now, what is going to happen is that I'm an accountant in this business. The business is the one that does the selling of books. So I'm going to open two accounts. James is our customer. So I'm going to open, we've seen that this person paid by, let's say even if the person didn't pay, you sold the book. So once you've sold, meaning we've gotten, as a business, we are recording a sale. The other side, in the James, who is the customer, we are going to put James here. The account is going to be for James because we've not seen whether we've paid by cash or James paid by cash or by bank. Meaning, if a transaction is just open like this, it means it was sold on credit. So what is going to happen is that this is we, the business. We've lost the book, but at the same time we have received money. But in this time round, we've not received the money, but we got a receivable. Otherwise, if we had received the money, we would have put a cash account here. So what we are going to do, since this person didn't pay us, we are still demanding him. What is going to happen is that we are going to come here to write the sales. We are going to put James's name. We say James, maybe $100. If we had the dates, we would have started with the dates. So for every, now you see, this is a credit entry, meaning we must have a corresponding debit entry. It's going to be in the James's account in the names of sales of $100. But you can't come here, since you have already a credit entry, and you also come and you put it this side. It won't make sense. Now, if this person, if James pays us, what is going to happen is that we are going to have two accounts where his money is reducing, or his money is going to be reducing, but he's going to be clearing himself from the obligation that he has with the business. So we shall look at some of those entries as we go on. Now, as I said earlier, that an account is a page of a ledger. A page of a ledger is what we call an account. Let me hope that you have understood that one at least. And now that we know what an account is, that it is a page of a ledger, but we also need to understand why we conduct, or why we usually record these transactions into those accounts. So an account, we said, is a page of a ledger, but why are we recording this information there? So the information we are going to be recording in these ledgers are going to be the records of transaction related to persons or property. It can be a person, it can be a property. So you will see that accounts will always be related to a person or a property. And we have two broad classifications of accounts. We have the personal accounts and then the impersonal accounts. So we said that the ledger is a page. Say the ledger is a page. It's a page. Said an account is a page. An account is a page. Is a page of a ledger. Is a page of a ledger which records transactions related to a person or property. So any account is going to be, that's the definition of an account. So you will see that the accounts will always be related to either a person or a property. And there are two broad classifications of accounts. When we talk about accounts, I have two broad classifications. We have the personal accounts, and then we have the impersonal. Just like the way we have personal ledger account, personal ledgers, and impersonal ledgers. So we have looked at, when we looked at the definition of an account, we saw that it's only prudent to understand that once we record transactions relating to persons or that are relating to properties, then we have the two broad classifications. Then, of course, we have to understand that the accounts that are going to be related to personal accounts will be related to persons, and the ones that are impersonal accounts, they are going to be those accounts that are going to be related to properties. So these impersonal accounts are going to be related to properties of business organizations. And those are the two broad classifications of accounts. But now we need to understand what are personal accounts and what are impersonal accounts. First of all, let's look at the personal accounts. Personal accounts. Now, a personal account is an account that is kept for a person. Is an account that is kept for a person. That is kept for persons. But I want to clarify something, that in financial accounting, we talked about persons. And when you're talking about persons, we are not just talking about human beings, but we are also referring to the business organizations. Because we said, as per the business entity concept, we say that business organizations have a right to exist separate from their owners, meaning they can own their assets, they can be sued, they can also sue, they can also be liable to the different liabilities that may be there in their capacities. So persons, we are basically looking at the natural person, and at the same time we look at the artificial persons. So an account of a person can be in your book as a creditor, can be in your book as a supplier, or can be in your books as a debtor. So persons may be debtors or creditors, and there is no other way you record an account of a person except when that person is a debtor or that person is a creditor. But when it's a business organization, we can have, because we've said the creditor can actually be a human being or a business organization. Even a debtor can also be a business organization, or you can actually be an individual person. But when it comes to the impersonal accounts, we say these accounts, these are accounts that are going to be kept for properties. But you have also to understand that there are two different types of properties, where we have the tangible properties, the properties that we may keep can have the tangible properties, or we can have the intangible properties. So however much the impersonal accounts are properties, but properties are going to be categorized into those that are tangible in nature and those that are intangible properties. So this means that these impersonal accounts should be split into two broad classifications, whereby one will be taking care of the intangible properties and the other will take care of the tangible properties. But the accounts that are going to take care of the tangible assets, the ones that are going to be taking care of the tangible assets, these ones, they are the ones we call real accounts. They are real accounts. They are going to be taking care of the tangible properties. And the account that is going to take care of the intangible properties is what we call the nominal account. So when we talk about the impersonal accounts, we are basically looking at, we are going to split them into the real accounts and then the nominal accounts. So we have three main classes of accounts. So from what we have discussed, we've seen that we have three main types of or main classes of accounts from the whole information that we've been talking about. We've seen that we have the personal accounts, we have the real accounts, and then we have the nominal accounts. And these nominal accounts and the real accounts are the impersonal accounts. Now, these impersonal accounts will not appear anywhere because the impersonal accounts have been split into real accounts or nominal accounts. So whenever we are going to be talking about the impersonal accounts, we are going to be referring to either real accounts that are going to be handling the tangible properties, or nominal accounts that are going to be holding the intangible properties. So maybe we can try to explain more on these classes of accounts. Now, we are going to break down these classes of accounts. We've talked about the personal accounts, and these are going to be for individuals. Two, we've looked at the real accounts, and the third one we've looked at the nominal accounts. We need to understand these so that we can be able to apply the double entry system. So we have the personal accounts, real accounts, and then the nominal accounts. And these are the three broad accounts that we have. And we are going to define each of these accounts. Now, we said that for personal accounts, these are basically relating to debtors and creditors, because they are representing these debtors or creditors. They can be individual human beings or they could be business organizations. But the real accounts, these real accounts, we say that for real accounts, these are going to be talking about the tangible properties. And tangible properties are going to be things that we can actually see and we can touch. In other words, they have a physical existence. If, for example, a motor vehicle account, you can actually see a motor vehicle. If you buy a motor vehicle, then you are going to be able to see it and touch it. If it is a building, if it is a land account, if it is a cash account, whether cash is going to be at bank or is going to be at hand, because we can see it and touch it. But when we come to the nominal accounts, these nominal accounts are going to be handling nominal accounts. These ones are specifically handling intangible assets. Intangible assets. Now, for these intangible assets, these are going to be assets that we can't touch and we can't see them. So in intangible properties, we are not mainly meaning assets alone, but intangible assets, properties. When we talk about properties, we are not meaning assets alone, but we are meaning all those items. They could be expenditures, they could be income items. So it may be an income or expense item, because you can't touch an expense. You can't say I've touched rent. You can't say I've touched the electricity. So these are things that we are going to be seeing. So we may have salaries. In terms of expenses, we may have rent accounts. You can't say that maybe you have seen a salary or you have seen a rent. But what we can only see, if for example, for salaries, we can see cash moving in, meaning the money will be paid to your bank account. That's what we can see, but that's not a salary. Meaning the salary account, that can't be seen, but you see the money that has been paid to you. Even for rent, you only see the money you have issued out, like you have paid out, but not seeing the physical rent account. So the nominal accounts that we are talking about, or the intangible properties that we are talking about here, they could be income or expenditure line items. So if we talk about the salary account, is just an imaginary meaning. In other words, it's something you can't see. Even when you have been paid salary, the only thing you can see is the money dropping into your bank account, meaning you'll be seeing cash, but you won't be seeing the salary account itself. So we are going to be having a lot of properties or intangible properties. And these properties, they don't have exist. That's why I was saying, when we talk about the intangible properties, it's not that we are meaning assets. No, we are meaning properties that could be in a sense where they can't be seen, like insurance account. So we shall understand the nominal accounts, especially if we try to do some numbers, but just know these are things you can't touch and you can't see. But we are not basically meaning assets. So nominal accounts is going to be taking all those different items that can't have a physical existence. The reason as why we are focusing on this, by first understanding these three types of accounts, is it's going to help us find a way of how we are going to handle the double entry. So our three classes of accounts, we've looked at them. Personal accounts, those are going to be handling debtors and creditors. Real accounts, those are going to be handling tangible property, things you can touch and see. You have bought furniture, you can actually see it, feel it, and touch it. But the nominal accounts, those are things you can't touch. Like, for example, you can't say you've spent, you have a transport account, but you can't say I've touched transport. The only thing you will be seeing is the money moving out to clear the transport expense. So those are some of the things that we are going to look at. Now, we want to get the general rules or the general way how we are going to handle the double entry using these three accounts, because we said nothing else is going to be opened an account for other than these three accounts that we have mentioned. So remember, I told you that the double entry recording must be done in an account. And because we say that for every debit entry must have a corresponding credit entry, and all that is supposed to be done in an account. And we defined an account as a page of a ledger where transactions are recorded. Now, the biggest problem, especially to people who are just starting, who are maybe a little bit fresh in accounting, is that they don't actually know how even to apply the principle of double entry. And it is just something, it's just a rule that has been tested, whether you understand it, whether you don't understand it, but it's a rule that has been tested for over years. But we want to find a general way how we can understand what is supposed to be debited, what is supposed to be credited, by looking at these three types of accounts or classes of accounts. So I want to make the things a little bit clear, because this very topic is going to help us create a very good foundation for our understanding of a lot of things to do with the correction of errors, things to do with getting the suspense accounts, trial balance, and all other kind of stuff. So if at all you don't understand this, then it means even extracting the trial balance from these ledger accounts is going to be a little bit challenging on your side. So we need to find ways how we can make sure understand this topic. So what we are going to do, we are going to start recording transaction in these three accounts that we have talked about, which are personal accounts, real accounts, and then nominal accounts. But the question is, how do you record? For example, if I see an account like cash account, in other words, how do you know that this kind of transaction is supposed to be debited or credited? And that's the rule that we are going to decide, or that is the one that we are going to, that is going to get to guide us on what to do. But the good thing, we know the general principle or the general rule, which is the golden rule of accounting, that for every debit entry must have a corresponding credit entry, and for every credit entry must have a corresponding debit entry. Now, some rules that we need to look at, some rules that are going to help us break down the other double entry bookkeeping. Because if you just take it the other way and you try to understand it without putting in the aspect of these accounts, it will be a little bit weird, especially for those who don't have an accounting background. So I want to break down these rules, and we see if we look at personal accounts, what do we do? If you identify that this is a personal account, then what do we do? So let's now try to look at recording in those accounts, recording in the accounts. Now, if we take maybe, let's say, the personal accounts. If we take, let's say, the personal accounts, and then we try to create a special rule for these personal accounts. Now, it will be the same thing that we are going to do for the real accounts. And then for the nominal accounts. And what we are going to do is for this double entry rule, which says that for every debit entry must have a corresponding credit entry. We are going to find a way of how we are going to reorganize it into debits and credits. So it is the only way that is going to guide us to be able to handle each of these accounts. So we are going to use the debits and the credits. So let's start the rules. Now, the rules that we are going to use for personal accounts. Now, when it comes to personal accounts, we say that personal accounts, these are going to be accounts for persons. Now, the general rule is going to be the issue is going to be like these personal accounts, we are either someone is going to be receiving because they are going to be for persons. And we've said that the persons can actually be an organization, it can be a normal human being. But let's take, for instance, it is a human being. Someone is going to be receiving something and the other is going to be giving something. So there is someone who is going to be giving out and there is someone who is going to be receiving. Now, the rule that we are going to use is that we are going to debit the receiver, the person who is going to be receiving. We debit the receiver and then we credit the giver. So the person who is going to be giving out, we credit that person. The reason why we are crediting that person, because he's losing whatever is giving out. The other one, the receiver, is going to be, we are debiting that person because he's going to be receiving. He's going to be increasing on what they have. So whenever you see a personal account, just take this rule that for personal accounts, we debit the receiver and then credit the giver. So if you are selling goods, let's say we are selling goods to ABC Limited, for example, maybe for 10 million. Then this ABC is also a person. ABC Limited is a person, even though it's an artificial person. Then you have to ask yourself whether ABC is going to be receiving the goods or is going to be giving the goods. If you find that ABC Limited is receiving, then you debit. You debit its account. And if you find that ABC Limited is the one giving, so if you find that ABC Limited is the one that is maybe giving out or is the one selling, then it means that this ABC is actually the one giving out, meaning it's supposed to be credited. So the rule for this personal account is just simple. You just debit the receiver and then credit the giver. And that's the rule that we are going to use for personal accounts and nothing else. So that's how we are going to be recording these transactions for personal accounts. You just look at who is receiving whatever they are receiving. If it is money, who is receiving? If this person is receiving, we debit. If the other one is giving, we credit. Remember that personal accounts, those are accounts that are belonging to persons, and these persons are supposed to be creditors or debtors. We are not going to have anything to do with any other account other than those two. And not forgetting that we said that a person, this creditor, is the normal person. It can be an individual or a human being or a natural person, or it can be an artificial person or a business organization. So let's look at the other rule for the other accounts. So I've seen one, personal accounts. So now let's look at the real accounts. And we've said these real accounts, we've said that these accounts of tangible properties, meaning that they have physical existence. And because they can be seen and touched, then we can say whichever that falls in that category is supposed to be grouped under the real accounts. Now, since they can be seen and touched, it means that we can see them when they are coming in. We can also see them when they are moving out, because we can see them and we can touch them. So once we can touch them, we can know that this one is actually going out or it is coming in. So we are going to also craft our rule that is going to help us understand the double entry for the real accounts. So as we said that since something is going to be seen coming in or moving out, if let's say we buy a motor vehicle, we will be seeing it. It will come and park at our premises. Once we sell it, we will also be seeing it moving out. So if you are buying motor vehicle, then we can actually see it coming in, and if we sell it off or if we dispose it off, then we can actually see it going out of the business. However, real accounts are dealing with properties and not persons. These are supposed to be properties, not persons, because we said the broader classifications were personal accounts and then impersonal accounts. Personal accounts were dealing for persons. Then impersonal accounts, they are the ones that were dealing with properties. So here for the real accounts, we are talking about properties, not person. So you can't use a rule for real accounts if at all you are dealing with a human being or you are dealing with a person. So now what we are going to do for these real accounts, we are going to debit what is coming in and then we credit what is going out. So the rule is we debit what is coming in, then we credit what is going out. So if they give you a transaction relating to an asset, the question is that asset coming in or it has been sold off? Once it is coming in the business, we debit. Once it is going out, we credit. So that's the rule that we are going to use, that is going to help us work on real accounts. And whether it's going to be cash, whether it is going to be motor vehicle, whether it's going to be land, whatever it is, as long as it can be seen, it can be touched. In other words, the kind of item, the kind of property they have given you will help you to determine whether you're supposed to credit it or debit it. The only thing you have to ask yourself for real accounts is that, is it coming in or going out? And if it is coming in, you debit it. You debit the account. If it is going out, you credit the account. So that's it. That's the rule number 2 for real accounts. So let's look at the nominal accounts. Now, when it comes to nominal accounts, I told you that it's mainly expenditures and incomes. We explained what an expenditure is. It is different from an expense, because expenditure is just a broad category, but an expense is just a type of an expenditure. So it can be an expenditure or an income. And over here, things change a little bit, because the reason as why these things keep on changing is that you could see that for personal accounts, they were debiting the receiver and we are crediting the giver. In other words, for the personal accounts, it's like we are almost the debits were for a gain, and that's how literally it was actually showing from the other side. But if you look at the personal account, now if it comes to the nominal accounts, because we have things like expenses and losses, we are going to categorize it based on whether this is an expense or it is an income or it is a gain. So what we are going to do here, we debit the expense or loss. I was saying that for nominal accounts, we have some slight changes that may appear to be a little bit different from how we've been discussing this. Now, for nominal accounts, we said we have most of the things that we have expenses or expenditure. Expenditures and incomes. We also have equity, expenditure and incomes, and also equity components. So things here are a little bit different in the sense that when we looked at the personal accounts, most of the times we are debiting the receiver. And if we are debiting the receiver, it comes in a sense, it makes someone believe that all debits are going to be gains. Like if you are receiving something, we say we debit, because that's what we've been talking about in as far as personal accounts are concerned. But for now, when it comes to nominal accounts, things are going to be a little bit different. It's not that all debits are going to be gains, as we saw it under the other side for the personal accounts. But we need to see how, or what is the principle behind the nominal accounts. Because for these nominal accounts, the principle is one, that you are going to debit all expenses. In fact, there are expenses and losses. Debit all expenses and losses, and then you credit all incomes and gains. In other words, if you have a gains account, you're supposed to credit it. If it is an income account, something that is bringing in an income, supposed to be credited. So I'm going to explain why we are doing it in that perspective. But those are the basic rules that we have as far as the nominal accounts are concerned. We said nominal accounts are those accounts that are going to be intangible in nature, intangible properties. When we talk about properties, we are not necessarily meaning assets. We are looking at things which we can't see, we can't touch with our own, we can't see them with our own naked eyes. So now, and I pray that you get actually these rules, because if you don't actually get these rules, it's going to be a little bit disturbing. And as a matter of fact, if you don't really understand these rules, then it will take you more time to be able to do the practical simulations, because this is what we are going to be using to help us drive whatever we are going to be doing. It's the one that is going to guide us even on the next sessions that we are going to be having, because we are going to be recording transactions in accounts based on these same rules. So you must understand, and we are going to look at the practicability of these rules. And someone may be wondering, like, for the nominal accounts, why are we debiting incomes? Like, why are we debiting the expenses and we are crediting the incomes? Because someone may be saying, if you go by the other aspect of the personal accounts, you will be seeing as if debiting incomes is like a positive variable, is more of a positive aspect. Someone may be wondering, why are we not debiting incomes and crediting expenses? Because for them, when they look at expenses, it's like, for them, their expenses is just a release of money. But the key point is that however much the other one looks a bit to be as if incomes are something that is positive or a positive variable, yet we are crediting it. And I want to tell you something that, like, for example, if let's say we are paying rent by cash of, let's say, 1 million, the two accounts that are going to be affected, we are going to have a rent account and then the cash account. So what you have to first know is, by knowing, is a cash account is going to be falling under which class of accounts, then rent account is going to be falling in which account, in which class of accounts. So you have to just know that if I'm looking at the cash account, that one I just know it is a real account, because I can actually see the money I have at hand, even when money is in the bank, it can actually be seen. But now if you look at the rent expense, you can't see it. You just know it is a nominal. It is a nominal account. So what we will be doing, it will be like we will open these two accounts. We have the rent account, and we have this cash account. But we've said, if let's say we paid in, it is in 1,000, just remove some 3 zeros up here. Now what we are going to do for such a transaction, you ask yourself, is rent account a personal account? Is it a real account or a nominal account? You conclude that it's a nominal account. And we said nominal accounts, the issue is if it is an expense, we debit it. If it is an income, we credit it. So since rent is an expense, we are just going to say debit rent account. So it is going to be rent account. We are debiting it in the name of cash, because we are spending money by cash of 1 million. Then, of course, the corresponding entry, as long as you have identified one account, if you have known, if maybe you know very well that cash account is a real account, and you know the rules for real accounts, then you just record that. Then of course the other one is going to be the corresponding of whichever account that you've looked at. Now for rent account, we've debited because it's an expense and it's a nominal account. So the corresponding entry must be credited to the cash. And if you look at it from the cash perspective, real accounts, we said if something is coming in, we debit. If we were receiving money, we would have debited our account. But since money is moving out of the business, but through paying rent, then you can just say credit cash account in the name of rent, 1 million. So you just need to know one account. If the criteria is for you to first identify the two accounts, because we said the double entry system has a double effect or has a double impact on every party to a given transaction. It gives the person double effect, or the impact comes when it is two-sided. That's why we are saying for every debit entry, we must have a corresponding credit entry. Then the reverse is true. So after identifying the two accounts, then the next thing to do is to draw the two accounts that you have identified. Then the other thing is to know which type of account is it. If you can't identify, then you will have a problem, because you'll find yourself you can't know which one to credit and which one to debit. So rent account, a nominal account, and the cash account is a real account. So once you've known those, then you can be able to see if we are paying rent with cash as a business. Because now, when you're answering some of these transactions, you have to make sure that you are standing in as the accountant of the organization. You are the accountant of the entity in the question. Because someone, if at all you don't position yourself to be in the organization, you may see it differently. But if you look at rent, that it is us, the business, that is paying out money to settle a given expense. So you position yourself as if you are part of that organization that they have given you in the question. That's the only way you will be able to see it in a clear way. So the starting point is always on the side of the business. Because if you look at it in the side of the business, you'll be looking at, in a sense, that if you are paying rent for our premises, then it means cash is going to go out, or whether cash is going to be coming in. And that's the first thing that we ask ourselves. Are we paying out, or cash is coming in? And the rule for real accounts, we said we credit what goes out, and because cash is going out, then we are going to credit the cash account by that 1 million. But it should be in the name of rent, since the money is going out to pay the rent. So once you know one entry, then the other, the reverse is true. As long as you can identify one account and you know how you can be able to give its rule. If I've identified that this is a nominal account, then you can, because if I look at rent and I can basically tell that this is an expense. So if you can know that, then you can say we debit it. And we are debiting it because it's a nominal account. And the rule for nominal accounts: debit all expenses and losses, credit incomes, all incomes and gains. So that's basically what we wanted to look at. We can have something small, just like the one transaction. We see how we can be able to interpret it. Can say maybe KC group sold goods worth shillings 150 to James, and bought goods on credit worth shillings 200,000 from acca Limited. Now, this is the case that we have. It's not a simulation. We are going to look at simulation as our next idea, but we want to just sort this small example. We see if at all we can be able to apply what we have got. So KC Group sold goods worth 150. It is, we have KC Group, they are selling goods worth 150 to James. And the same company, KC Group, bought goods on credit worth 200,000 from KK Group. Now, the first thing you do is to identify the two accounts. In any transaction, you first identify the two accounts. Now, in this small illustration, we have two transactions. We have when KC Group is selling goods worth 150 to James. And also we have the same KC Group buying goods on credit from KK Limited. So we have two transactions. We are going to work on one by one. Now, the first one is when KC Group is our first party. KC Group sold to James, and the amount was 150. No, that is our first transaction. Here we are selling, they are selling goods to James worth 150. Now, in this case, we can see that one of the entity, because these are personal accounts, we have KC Group as a person, even though it's a natural person. Remember, we said these persons, someone can, according to the business entity concept, the company is going to be different from its owner, so it can stand on its own. So KC Group is an artificial person, but we have James, who is a human being, meaning these are personal accounts. And we say the rule for personal accounts, we debit the receiver, then we credit the giver. Now, in this scenario where KC Group is selling goods to James, we have James is going to be receiving. James is receiving goods. And at the same time, we are seeing KC Group, which is the company, is the one giving out. So since James has received goods from KC Group, then what we are going to do, we are going to debit the James's account with the amount of 150, because the other KC Group is going to be losing out. So what we will do to them, we shall just be crediting. So the two accounts, we are going to have where James is receiving the goods, but since the company is losing out the goods, but these goods, they are going to be losing them out, but they are going to be receiving the sales as a business. So if you identify in this category, if you can identify that James is a person, just do one entry. The rest will be the opposite. So when you open the account, James's account, because it's going to be a data, it's going to come in the name of sales of 150, because they have not told us whether this person paid money or he didn't pay. But since they have not told us that this person paid, it means they must have sold, the company sold to him on credit. So we get the sales, the business will be having the sales, but the other guys are going to be, James is going to be receiving the goods. So put under the sales, we credit it in the names of James, 150. That will be the entry. But you don't take it to be in a sense that the other company, since it's giving out, you credit the company. No, this one is coming in as a sale. And you know our sales are going to be like, we are more of receiving income. Sales accounts are going to be, they are going to be nominal accounts. Now the other is this last part where KC Group is actually buying goods. So if we are buying goods for the purposes of reselling, we say we have gotten purchases. So the two accounts, since we are buying goods, we are going to have purchases, and then since we have not paid, we are going to have KK Limited as the other account. So in the books of KC Limited, we are positioning ourselves as the accountants of KC group. That's why for us we are more of recording the purchases than taking the name of the company. So in our books we are going to record them as if we have received purchases or goods that we can sell out. So you identify one item. You just know that this KK Limited is going to be is a personal account, because it's a company that we are buying on credit and we are creating a liability to the business. So you just know an account, then the other you'll be knowing. So we create two accounts, the one for purchases and KK Limited purchases. So KK, since it is a personal account and is the one losing goods to us, meaning for him is giving out, and when we are giving out we credit. So we shall come to KK Limited, we credit it in the names of purchases 200,000. Then we come to purchases. Of course we take the corresponding entry, as long as you have gotten one account and it's right. The other, just take the corresponding entry. So we come to purchases and we debit it with in the names of KK Limited 200,000. So if it was issues to do with cash, we said that cash, we don't open an account for it. Those purchases that were in cash, we paid money, those ones go to our cash book, but we don't open ledger accounts for something that we have sold or we have purchased on with our own money. So that's it. So we shall look at a broader number maybe in the next lecture, then we'll be able to adjust